a.m. in New York City. Good morning. I'm Bonnie Quinn in for Danny Berger with your Bloomberg Brief. Here's what you need to know. Stocks rise and the dollar bounces back just a little bit following a brief drama, you could say, over Fed Chair Jerome Powell's future. Also, patient Fed speak. And the latest on trade. President Donald Trump floats 10 to 15% tariffs for more than 150 nations. And earnings continue. TSMC boosts its sales growth outlook as AI orders run hot. So let's take a look at how that is impacting the markets as we approach the open in just a few hours' time. We see very, very small upside for futures. That's after a very whippy day yesterday. Of course, the possibility of an imminent ouster of Fed Chair Jerome Powell was in the market yesterday. Will it percolate into today's session? We'll have to see. We'll have to see if Donald Trump makes more comments to that effect and what kind of notes are floating around Wall Street. We saw mainly the reaction in bonds and FX yesterday. There's also the idea that TSMC's outlook is providing some optimism. Of course, Nvidia still has to report. Will that percolate also into the US session? It certainly had a good impact on the Asia session. As you can see, the two-year yield is still at 390, so not much movement after we saw that steepening of the curve yesterday, a twist steepening no less. In fact, the 530 spread was at 108 basis points, which is the widest we've seen since 2021. So it was quite the market reaction from those pieces of drama, let's say, inside and outside the Oval Office. The 10-year yield at 446.94 and the 30-year yield still above that 5% mark, 503.13. So we will be very much watching what the bond market in particular does in today's session. Let's get down now to some individual stocks to watch, and let's get over to Bloomberg's Valerie Teitel. Valerie.
Good morning, Bonnie. Let's start with United Airlines. They reinstated their guidance, citing decreased uncertainty, better travel demand. But this reinstated guidance was lower than their rosy first quarter outlook at the beginning of the year. We're seeing those stocks drop 3% in pre-market trade. Let's move on to more the agricultural industry. We're seeing Archer Daniels Midlands. This is a main producer of corn syrup, falling 5% in pre-market trade. This comes after Trump declared on Truth Social that Coca-Cola would start making its sodas using cane sugar instead of corn syrup, which ADM makes. We did hear a comment from Coca-Cola. They said, be aware there are some new products coming out. Also, let's take a look at the stocks reporting today. We do have a fair few. The big one being before the bell is PepsiCo for maybe a guide on the consumer appetite. We then have GE Aerospace also before the bell. And later today, Netflix reports after the market close. Bonnie.
Fantastic, Valerie. We'll be watching all of that throughout the day and much appreciated. And joining us this hour, George Saravelos of Deutsche Bank. He's warning, of course, of major market consequences if Trump does indeed fire Powell. And we dig into the resilience of the US economy with JPMorgan's Sitara Sundar. So the drama over firing Chair J. Powell calms down potentially for a little bit now while President Donald Trump continues to pressure the Fed chief. George Saravelos of Deutsche Bank had weighed in on the market implications of any potential change at the Fed, writing this, quote, "In extreme cases, both the currency and the bond market can collapse as inflation expectations move higher. We consider the removal of Chair Powell as one of the largest underpriced event risks over the coming months." George joins us now. He's Global Head of FX Research at Deutsche Bank. So, George, we got a potential preview of what might actually happen should the Fed chair either end up getting fired or resigning. Was yesterday's market reaction what you might have anticipated?
So we published the note you cited over the weekend and didn't expect these headlines to come out so quickly. We wrote that within 24 hours of such an announcement, the dollar could fall 2 to 3%. And I think if you look at the orders of magnitudes of the moves, both in fixed income and in currencies, they were very similar to what we were anticipating. They were very large. Of course, they subsequently reversed because of the denial. But I do think this underlying story, so long as it lingers, it will weigh, it will act as a big headwind, both for the dollar and fixed income, until it gets resolved one way or another.
Yeah, for sure. And we'll see what happens with market reaction today, because it is constantly percolating through the market, this narrative, right? Every time it goes away, it comes back. I'm curious, the closer we get to actually a rate cut, does it make it less pronounced if there is a change at the head of the Fed?
So I do think we have to separate the issue of who is appointed, and they may lean dovish, they may lean hawkish. But if the appointment process is orderly, at least this retains the so-called institutional credibility of the process. It prevents uncertainty. And then we have to distinguish between that and the more disorderly situation where Powell potentially is asked to leave. And in that scenario, Powell could potentially refuse to do so. You may be in a situation where you're in a legal standoff between the Fed chair and a potential new appointment that could last for weeks, even months. And that is a really bad scenario. So I think, as you say, if we go closer to the date where Powell anyway is closer to leaving, that at least should remove some of that extreme tail risk and the risk of institutional duress for the Fed, which I think would have a very negative market reaction.
Now, the twist that we saw on the curve yesterday was fascinating as a reaction, because it's not necessarily what the president would want in a scenario where there was a different head of the Fed, right? I mean, obviously, we saw lower-end yields move lower, front-end yields move lower and back-end yields move higher, but it's the 10-year and the 30-year and everything that's dependent on mortgages and so on that the president wants lower. So is that any indication that, you know, he wouldn't get what he wants from the market anyway?
I think absolutely, and it's one reason to question whether he would ultimately follow through with these threats, because we fully believe such a move would be counterproductive. I can't stress enough how much the US is exposed at the moment in terms of its external vulnerabilities. So if you look at the situation where you have a fiscal deficit that's likely to be somewhere in the range of 6 to 8%, depending on what you assume around some of these forthcoming tax cuts and spending cuts. So a fiscal deficit of 6 to 8% of GDP, a current account deficit of 4 to 5% potentially of GDP, and then an external position of nearly 100% of GDP. And these are numbers that you don't see in any other developed market economy or in an emerging market economy, and they just point to the vulnerability in terms of being reliant on foreign funding and the vulnerability of the loss of Fed independence. So it would be counterproductive, and I think that is likely one reason why potentially the president would not follow through. But as we can see, the probability is not zero, and the market is pricing off probabilities.
And, you know, participants in the market are questioning if there are other scenarios where he might need something like this in order to take the spotlight off a different narrative, let's say. So there might be a whole different reason for him to actually, you know, mess with the Fed, as it were. Lael Brainerd, to your point, was on Bloomberg television yesterday, and she said, look, the Fed cannot subordinate its mandate to debt management. Is there any formation of a Federal Reserve, any hypothetical Federal Reserve formation where debt management would be a consideration?
I think President Trump, via his appointment powers, can for sure lean the Fed one way or another. So he can have influence, and you can see that in market pricing, where the curve has, the money market curve has a so-called kink in the second quarter of next year when the new Fed chair is meant to take hold. But I think if you take a step back and you look at what historically happens in situations where you have very high debt loads, and a restructuring is out of the question, which I think we should argue is the case for the US. Well, we get a combination of financial repression, which is effectively the government in direct or indirect ways forcing the domestic private sector to absorb more duration and more debt. So it starts with the banks, and we're seeing some movements around shifts in bank regulation to encourage the banks to absorb debt. And it means also negative real rates. So rates are lower than they should be. You effectively lose money when you own fixed income instruments, and effectively the value of the debt is eroded by inflation. So I think that's the broad direction of travel we're going through. Now, how aggressive or disorderly the moves can be in that process will absolutely depend on President Trump and the White House.
And who it might be, exactly. So given that, you know, you think about FX all the time, the dollar index, the DXY down 9% already this year, the BBDXY down just less than 8%. I'm curious as to your outlook for the US dollar and what other currencies might benefit from dollar weakness, given that I know you have to also take into account tariffs, and we don't even know what they'll finally be yet.
So we're going through a period of consolidation at the moment in the market, but our view is very much one of a structural dollar downtrend. And at the core of the view, it goes back to this issue of twin deficits. The market has revised down its willingness to fund the size of these US twin deficits, partly in response to these uncertainties you alluded to. One is trade, one relates to the Fed. But I think there is a broader macro picture taking place. And if I was to summarize it into two parts, in the US, the dominant macro force at the moment, I think, is a negative supply shock. And there is a very large discussion on tariffs and the back and forth. But the bigger shock is taking place in the labor market and in immigration. And if you look at some of the shifts that are undergoing that are likely to hit the economy in the second half, we're talking about a very, very sharp reduction in labor force growth, which I think will have a very real impact in terms of the GDP growth numbers. So that's a negative supply shock in the US, while in the rest of the world, fiscal policy is expanding. We're seeing a positive demand shock. And if you combine those two with the twin deficit discussion, I think the dollar path is still lower.
All right, George, thank you so much. You were pretty prescient this week with your notes, so be on the lookout for the next one. That's George Saravelos of Deutsche Bank. Now on to other top stories trending on the terminal this morning. TSMC sees sales growth of about 30% this year, shoring up investor confidence in the global AI spending spree. The chipmaker's CFO did warn that the company's third quarter performance could face a bigger hit from a strong local currency. JPMorgan racked up a $30 billion profit in the first half, more than double its closest rival. It further widened its lead over Goldman Sachs and Morgan Stanley in investment banking revenue. The bank's market value now exceeds that of Bank of America, Citi and Wells Fargo combined. Meanwhile, Wall Street banks are missing out on millions of dollars in fees after Sitara abandoned its bid to buy Seven & i Holdings. The year-long pursuit could have been the biggest foreign takeover of a Japanese company, but it ended in acrimony, with the Canadian chain blaming the 7-Eleven owners' board for, quote, obfuscation and delay. Coming up, President Trump lays out a potential tariff for more than 150 nations. More from Washington and also from the G20 next. This is Bloomberg.
For all of us who are exporting to the country that imposes tariffs, there is an impact on output. The issue about tariffs also raises important issues. We're having to grapple with what would this mean for the outlook of the US economy and the posture that the Fed might take in terms of monetary policy. It is not clear where we would end up. Uncertainty abound.
Well, he said it, uncertainties abound. That's the South African Reserve Bank governor speaking to Bloomberg at the G20. President Trump, of course, eyeing tariff rates of 10 or 15% for more than 150 countries. He said, quote, don't do much business, while talks continue with more significant trading partners for the United States. Let's bring in now Bloomberg's Brussels bureau chief, Suzanne Lynch. So, Suzanne, what's the latest on the EU trade talks? Do these letters somehow supersede what's going on there?
Yes, well, as we heard from President Trump here, there is a sense from Washington that they want to focus discussions on those bigger trade partners, and the European Union is one of those partners. I think it's fair to say that the European Union was very unnerved by the threat last weekend by Donald Trump to impose 30% tariffs. They had thought that the negotiations with Washington had been going relatively well, and they had been hoping to sign a provisional agreement. That has not happened, but they're still saying here in Brussels that they do want to get an agreement before August 1st. So this week we have senior officials from the European Commission, including the Trade Commissioner, Maros Sefcovic, is in Washington. He will be speaking to Mr. Greer, Howard Lutnick he spoke to earlier in the week. So the negotiations are continuing. At the same time, a lot of countries here, including France in particular, are saying, look, the EU is prepared to hit back if it doesn't agree a deal by August 1st.
Yes, so just another few days, really. It's, already the 17th of July. And then pressure from the Oval Office on Fed Chair Jerome Powell as well has been rising in recent days. Trump denied, of course, looking to fire him yesterday. Have a listen.
He's a terrible Fed chair. I was surprised he was appointed. I was surprised, frankly, that Biden put him in and extended him, but they did. So, no, we're not planning on doing anything. We're very concerned.
It's this constant drip, drip, drip of derogatory comments, right, Suzanne? And, you wonder, even though we saw the market react yesterday, do markets believe Donald Trump yet that, he won't fire him, but there's always the possibility he might?
Yeah, I think there is an argument that perhaps the markets are pricing in the Powell effect at this stage. There has been so much commentary from Donald Trump, so much seesawing on this issue that they are expecting some kind of change on this, and they're already looking to see who might be that replacement. Now, yesterday in particular, there was a very swift reaction to that report that Donald Trump was preparing, had a letter, was preparing to fire him. Then, of course, as we know, Donald Trump pulled back from that. But I think markets are watching this closely, and I think one of the concerns will be if Trump does decide to pick a loyalist, someone like Kevin Hassett, for example, who's had a long relationship with Donald Trump and was central as an economic advisor in the first Trump administration. If he does pick somebody like that, will the independence of the Fed still, be upheld? They're the kind of issues I think that markets are looking at, but are keeping a close watch on what happens there.
For sure, and 2 more days this week to see some market reaction. Our thanks to you. That is Bloomberg's Suzanne Lynch. Meantime, the world's most powerful finance ministers and central bank governors are gathering in South Africa for the G20 meeting. Attention is focused on limiting the fallout of a global trade war. For more, let's bring in Bloomberg's Oliver Crook. He's on location there at the G20. So, Oliver, what are you hearing? Is the fact that the US finance minister isn't there, is that dominating the discussion of everything, or, is it in the background?
So there are two sides of this, Vani. On the one hand, there is the agenda here for the G20, and on the other, there is what's happening in Washington, D.C., in the White House that is basically governing all discussions everywhere in the world, certainly in finance ministries across the world. And the finance ministers I've spoken to so far, and the ones that we'll be speaking to a little bit later throughout the next couple of days, are squarely focused on two things. On one, the trade war that is ongoing now with the United States, trying to get that deal now with that deadline less than 2 weeks away. And, of course, also the criticisms and the potential firing of Jerome Powell. Just yesterday, we were listening to that press conference after we saw all these headlines crossing about the potential firing of Jerome Powell. I was about to sit down with the Norwegian finance minister. His currency moved by 1 percentage point in the wake of that. And I asked him, how concerning is this to you in terms of global market stability, that these are the sorts of things that are going on? And that is very present in the minds of the finance ministers here. On the question of trade, and this is, I think, a really critical point here, there's going to be a question in the next couple of weeks of how the Europeans, the EU, can escalate pressure on the United States if they do not make any progress in these trade negotiations. And from what I am hearing today is we will have a meeting today from the European Commission and a number of representatives here from Germany, from France, from Italy, also with Canada, Japan, and South Korea. So this is building sort of a narrative and a conversation that we've been asking about for a while now, which is if there is a failure to make progress in negotiations with the United States at the EU level, could they band up potentially with countries like Canada, like Japan, like South Korea, in terms of having a collective approach with the United States? No one has been very open about talking about that because they don't want to upset Donald Trump, but that potentially is one of the conversations we're going to be having here at the sidelines of the G20.
Ollie, thank you so much. We'll be checking in with you periodically throughout. It's just getting started, really. That's Bloomberg's Oliver Crook at the G20 in South Africa. Coming up, PBS and NPR are set to lose federal funding from DOGE cuts. More on that and what else is making headlines around the world. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York, in for Danny Berger. Time now for our front page news, a look at what's making headlines around the world. First up, a Wall Street Journal exclusive. US officials are stalling a UAE Nvidia chips deal over security concerns. Some Trump officials are concerned that China could get access to cutting-edge US technology. Commerce Secretary Howard Lutnick met with representatives from the UAE and discussed how to move the agreement forward. Next, on the Washington Post, the Senate narrowly passing President Trump's bill to cut spending. The Senate voted 51-48 to approve the cuts to the Public Broadcasting Service, National Public Radio, and to foreign aid. The bill now heads to the House, which plans to send it to President Donald Trump's desk before a Friday deadline. And on the New York Times, immigrants filing a class action lawsuit to stop ICE courthouse arrests. A civil rights group sued the Trump administration over the agents detaining immigrants who were appearing for court dates. The lawsuit calls the detentions unlawful and a violation of due process protections. Let's get a check on markets now, just a few hours before the U.S. Open. We do have S&P futures pointing higher, just fractionally. Dow futures are also just a little higher, and Russell 2000 futures a little lower, mirroring a little bit what happened at the close of yesterday's session. Also on a little bit of optimism from TSMC results. And if you take a look at the 10-year yield, not much movement, not much give back after yesterday's price action. Coming up, we're going to be catching up with JPMorgan's Sitara Sundar on the resilience of corporate America. This is Bloomberg. It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn, standing in for Danny Berger, who is on assignment, and this is your Bloomberg Brief. Here's what you need to know. Stocks rise and the dollar bounces back following a brief drama over Fed Chair Jerome Powell's future. Also patient Fed speak. And the latest on trade, President Trump floats 10 to 15% tariffs for more than 150 nations. Also, earnings continue. TSMC boosts its sales growth outlook as AI orders run hot. So let's take a quick look at how markets are digesting all of this. It looks positive, at least for equity indices in the early going, with S&P futures and NASDAQ futures higher. Remember, they did resume their gains yesterday after that brief, well, I don't want to call it drama. It does percolate through the market day after day these days. Russell 2000 futures still lower, however. Let's move on to the bond market, because we saw much more of a massive reaction in bonds yesterday. Right now, we're not seeing too much give back, with the 2-year yield still at 3.90. The 30-year yield still at 5.02. So it was a 108 basis point spread between the 5 and 30-year at its peak yesterday. We haven't seen that since 2021. We'll be keeping an eye on bond market action today. And of course, plenty of auctions next week as well, which we'll be watching. So let's get down to some individual stocks to watch now and get over to Bloomberg's Valerie Teitel. Valerie.
Good morning, Bonnie. Let's start with some companies who released earnings after the bell yesterday. That was United Airlines. Those shares are trading down around 3%. They did reinstate their guidance, Bonnie, but it was a bit on the lower end and not as rosy as their Q1 outlook from the beginning of the year. So those stocks are trading lower. Let's move on to the agricultural industry. We are seeing makers of corn syrup struggle this morning, one of them being Archer Daniels Midlands, down over 5%. This comes after a Trump post on Truth Social saying that Coca-Cola has agreed to use cane sugar in its soda rather than corn syrup. Coca-Cola did respond, saying beyond the outlook for some new product launches. Lastly, let's end with some stocks to watch in terms of who else is reporting this morning. We do have PepsiCo before the bell with maybe a guide on U.S. consumer activity. GE Aerospace is also a big one reporting before the bell. And then after the market close, we get Netflix. Bonnie.
Definitely ramping up into earnings season. Valerie, thank you so much. Valerie Teitel there. And as she said, earnings season in full swing at this point. We'll hear from regional banks, Pepsi and General Electric this morning, Netflix after the market close. For more now, let's bring in Sitara Sundar of JPMorgan Private Bank. She's on set with me. So we know that we've seen some fairly good earnings so far. It hasn't been terrible, right? And your base case does suggest that earnings will support this market, but your base case is also at the high end where the market is at right now.
Yes.
So what does that suggest for the rest of earnings season?
Definitely. So I think first, thank you so much for having me. I love being here. I think there's two things that we're looking at when we think about what is going to propel equity markets moving forward, where we still have a positive outlook and we still expect mid-single-digit growth over the next year. So there's two things: what's happening in the economy and ultimately what's happening with earnings. So far in the economic growth front, we are seeing slowing, which is baked into our base case expectations, but we're still seeing resilience, and our base case is still for moderating but positive economic growth. We don't think the U.S. is going to enter a recession this year. On the second side of that, it's earnings, and we're, as you mentioned, in full swing when we think about earnings season so far this year. And when we project out over the next year, there's a couple of things that we think are going to end up driving earnings at the end of the day. One, we still think that tech and comm services are going to lead the way, and we still think that the profitability, net profit margins, and earnings outlook, especially when you think about CapEx and the growth behind artificial intelligence, is going to propel those two sectors moving forward. But the second and extremely crucial part in terms of what we're looking out for this earnings season too is participation and durable earnings growth in other sectors. So financials, we still feel positive about. Utilities, we still feel positive about. And if we look at calendar year 25 and calendar year 26, we're still expecting mid-single digit to low double-digit types of earnings growth over the next couple of years. And that's going to be because more sectors are participating.
How can you be so confident in that outlook, given the amount of tail risks out there, whether it's inflation, whether it's a change at the Fed, whether it's slowing growth, as you said, or just simply that CapEx comes back in and companies decide that they can't afford, with all the tariff uncertainty, to make these big pronouncements? Look,
it's the right question. There are the confluence of factors that we've seen so far this year: heightened geopolitical uncertainty about the duration of uncertainty around trade policy, what tariff risk is actually going to mean. But I think we also need to take a step back and think about the health of the corporate sector that we've seen, not even this year, but really over the past few years. Net profit margins have been above the historical average, the historical 5-year average, one. Two, we also need to remember that this is not the first trade-oriented uncertainty that this corporate sector and the economy has experienced so far. So if we take a step back and think about the 2018 trade war and then also the COVID supply chain disruptions that we've seen there too, there's already been a playbook for a lot of these corporations on reorganizing supply chains, reshoring some of this kind of domestic manufacturing type of activity, for one. And then two, because we're positive on earnings growth moving forward, it doesn't mean that there's going to be pockets of the market that are not going to hurt. Some of these cyclically oriented sectors, commodity oriented sectors are areas that we're actually avoiding at this point in time. And where we're actually focusing moving forward are more of these cycle agnostic secular opportunities. And we're paying attention to CapEx spending. We're going to be paying attention to guidance so far this year, but we still think AI is here to stay. We still think that it's trend that is going to permeate across all of these different sectors, which will shore up earnings growth over the long run.
But you are moving to software over semiconductors.
100%.
Shifting. And as we know, just a few months ago, the AI narrative went completely away when the tariff narrative came to the fore, and we're not certain that we're done with the tariff narrative yet. So you do also suggest some global diversification.
100%.
Well, where would you go in an environment like this?
It's the right question. You're asking all the right questions. Look, I think there's two things. One, the global diversification point is a public and private conversation, which we can talk about. We're talking about that. When we think about where we're finding the opportunity set, incrementally more positive on Europe across both public and private markets, and incrementally more positive on Japan as well. I think the amount of corporate governance reform, M&A reform, and the opening up of a lot of these management towards profitability and corporate profitability and the increase in ROE that we've seen within that space is not really being discounted in markets right now, given all of the noise around trade policy uncertainty, what's going to happen on that front. So when we think about that incremental opportunity, we're still constructive on Europe and we're still constructive on Japan. And we think that in a period of time where we have seen meaningful U.S. exceptionalism, if you think about the past 10 years and the dominance of mega cap tech, we still think that the U.S. has legs and that there's room for outperformance, but we're going to start to see those earnings growth differentials start to narrow.
When you're looking abroad, how much do you have to take into account currency differentials? How much does that really just end up being the deciding factor in whether you invest in a particular company, be it public or private?
It is something that you have to consider. Currency differentials, what's been happening with dollar weakness, and actually what we've been seeing is the impetus behind the international diversification story has been twofold. One, the revitalization of the European economy and fiscal stimulus and defense spending that we're seeing there too, but also this need for a lot of our US-based clients and US dollar-denominated clients to be diversifying their currency exposure too. So it's definitely something that you have to think about when you think about the relative value of both of those regions. But at the end of the day, everything that we try to do is trying to shift and see the signal through the noise and focus on the fundamentals. You can't just buy a market solely for the currency appreciation. There needs to be a durable story there. So we see that on both fronts.
And the other part of this change in portfolio from the 60-40 to sort of a more, maybe spicy portfolio
Sure.
where you can definitely count on some things at least, is you say infrastructure.
Yes.
That's sort of a no-brainer. Why, though?
It's, when I think about the next decade, it is going to look extremely different than the prior decade. So what do I mean by that? We're going to be having moderating economic growth, whether it's at potential or below potential, we'll see. But the two biggest factors that are going to change likely is that rates are going to stay higher. Even if we see base rates come lower and the Fed cut, it's likely that rates are going to stay higher for longer in this cycle than it was in the past cycle. And inflation is likely going to be stickier in this cycle than it was in the past cycle. So when we think about that moving forward, the definition of what a resilient portfolio and a durable portfolio is for the next decade is going to have to change in lockstep. So infrastructure is something that we've been increasingly excited about because of a handful of reasons. One, it provides inflation resilient income backed by multi-year contracts and contracted cash flow. So you know that income and therefore those total returns are going to be durable. And over the past 10 years, we've seen infrastructure, especially on the private side, clock in about 10% annualized returns, which I think surprises people. But also, two, when you think about everything that is happening in this ecosystem right now, about artificial intelligence, one of the biggest things that we've been talking about over the past couple of years is the power that's needed to fuel that.
For sure.
So when you think about the sector breakout within infrastructure as well, it used to be extremely transport heavy, toll roads, ports, and things like that about a decade ago. But really over the past couple of years, and even zooming out 5 years, power has become an increasingly bigger portion of that sector, and it's actually 60% of the global infrastructure ecosystem at this point in time.
And that's definitely going to be part of the AI conversation.
100%.
Forward to. Sitara, we have to leave it there, but we could totally speak for hours about this new type of portfolio that you're designing, and looking forward to the next time. That is Sitara Sundar of JPMorgan Private Bank. Now, on to other top stories trending on the terminal this morning. Citigroup and Wells Fargo are the latest to join a surge in Eurobond issuance by US issuers this year. US issuers raised 27% more selling Euro currency bonds so far. The reverse Yankee debt market is heating up, driven by cheaper Euro funding costs, dollar volatility, and anxiety over tariffs. A record share of American firms froze investments in China as trade ties worsened earlier this year. According to a recent survey by the US-China Business Council, fewer than half of the companies surveyed plan to invest in China in 2025. This is a record low. Not since 2006 have we seen these levels. Sundar abandons its bid to buy Seven & I Holdings. The year-long pursuit could have been the biggest foreign takeover of a Japanese company. The takeover bid ended in acrimony, with the Sundar crew blaming the 7-Eleven owners' board for, quote, obfuscation and delay. Coming up, Trump versus Powell. The president denies he's trying to fire the Fed chair. More on the White House pressure campaign next. This is Bloomberg.
We are in very close contact both with the European Union, we are part of the internal market, but also with the United States. We have, what should I say, a good tone. We are addressing some real issues, and again, it's too early to conclude, but the ambition is to prevent increases in the tariffs.
That was Norwegian Finance Minister and former NATO head Jens Stoltenberg speaking to Bloomberg at the G20 gathering in South Africa on, of course, trade uncertainty. Bloomberg's Brussels bureau chief Suzanne Lintz joins us now. Suzanne, President Trump has said he's eyeing tariff rates of 10 to 15% for more than 150 countries, and those letters have started to go out. What do we know about that set of nations?
Yes, we heard this from President Trump yesterday, the latest kind of salvo as he it continues this very aggressive trade strategy. And from what we gather, this are smaller countries, he said, probably smaller countries in Asia, up to 150 who will receive these letters. Now, if previous patterns are anything to go by, in one sense, we're hearing some feedback that would suggest that this could be a good thing for some countries who maybe believe that Donald Trump wants to wrap this up, that he's putting that number out there, and that there is room for negotiation on this to get it over the line by the August 1st deadline that he has set. For example, we saw that with Indonesia. They, quite quickly have struck a deal with Trump after a previous threat. So in one way, there could be a silver lining to this, but it does speak to the continuing uncertainty about what's next on the tariff front.
And then, Suzanne, what about the European Union, one of the largest trading partners for the United States? I thought that the negotiations were sort of coming to a head. Does these letters supersede that in any way, or how does it all come into the mix?
I think for the moment, Donald Trump made it clear that these were going to be smaller countries that would get these letters. And he did mention in those same comments that he was still negotiating with the EU and implying that something could be perhaps done relatively quickly. In saying that, I think there's growing nervousness here in Europe, particularly since Donald Trump threatened those 30% tariffs last weekend. That was a bolt out of the blue to a lot of the negotiators here who thought they were close to a provisional deal with Washington. Now, there's a two-track approach, if you like. On the one hand, the European Union is continuing with the negotiations, is saying that it is hopeful that a deal can be reached by August 1st, a provisional deal. On the other hand, however, they are quietly preparing other possible sanctions that could be used if this deal is not agreed by August 1st. So I think we're hearing growing number of voices here. France, from the very beginning of these trade negotiations, has been arguing for a bit more of a robust response by Europe. Now we're reporting that at least a half a dozen other countries are agreeing with them, really. So they are getting together and coming up with a plan that they could impose further actions, perhaps ultimately on US services, if a deal is not reached. But at the moment, they're still saying that a deal is in reach, and we have top EU trade negotiators in Washington this week hoping to make some progress.
Yeah, and August 1st isn't until tomorrow in 2 weeks, so plenty of time there. The other narrative is obviously the pressure from the Oval Office on Federal Reserve Chair Jerome Powell. It's been rising, it seems, in recent days, even though it's been percolating for months. But Trump did deny looking to fire him yesterday. Let's have a listen.
He's a terrible Fed chair. I was surprised he was appointed. I was surprised, frankly, that Biden put him in and extended him, but they did. So, no, we're not planning on doing anything. We're very concerned.
Markets reprice every time something like this happens. What do you think markets believe right now, Suzanne?
Yeah, there was a real flurry of activity yesterday with those initial reports that Donald Trump had a letter that he was preparing to fire the federal chairman. But of course, as we heard there, he wrote back on that. In one sense, I think we're seeing a possibility the markets are kind of pricing in the Powell effect at this stage. There has been a lot of over and back by Donald Trump on this, and I think there is an expectation that there will be movement on this sooner rather than later, despite that denial by Donald Trump yesterday. Of course, the big question is then who gets the job? Does he put in the place of Jerome Powell? Now, there are certain names, Kevin Hassett, for example, a real Trump loyalist, someone who's had a lot of experience in driving US economic policy under the Trump administration, both the first Trump administration and the second. So he is emerging as a key figure here who could be set up as a successor to Powell. Of course, the big question is for a lot of investors is whether Fed independence will be maintained in that event. So I think they're the kind of questions that markets are looking to be answered sooner rather than later.
For sure. Suzanne, thank you so much. That is Bloomberg's Suzanne Lynch in Brussels there. TSMC raised its outlook for 2025 revenue growth. It seals sales growth now of about 30%. Joining us now is Bloomberg intelligence analyst Charles Shum. That 30% was even characterized as conservative, Charles. Also, margins were better, so it seems like it was pretty much all good news from TSMC. What should we take away from it?
I think actually from this increase of the sales guidance indicate that the AI chip, first thing, most important is many people who are concerned is about the AI chip demand. Actually, that indicates that the AI chip demand is actually ongoing strong and will continue still be strong possibly in the 2025 second half. That's the most important question that the sales guidance answered. And also, this also indicates that there's a clear validation of the TSMC's competitive position in the advanced node manufacturing. And that's the second thing that we get from the new sales guidance number.
Now, there was a mention of NVIDIA. TSMC said it hadn't received a signal from NVIDIA. Do we know how it's going to play out with the H20 chip and what we can learn about NVIDIA?
Oh, that's a very good question. Yes, the management mentioned that they haven't pricing that the new approval from on the H20 chipset because we believe that many of these H20 chipset shipment coming is actually will deliver from TSM from the NVIDIA's warehouse instead of a new order placed to the TSMC. But still, we think that this actually H20 chip delivery resumption is a very good news for the TSMC because if NVIDIA are going to ship more AI chip, that actually still relying on TSMC to produce this and actually increase the coming 2026 growth prospects.
Yes, indeed. Charles, thank you. Certainly in the pre-market, we have NVIDIA higher and also, as you saw, TSMC higher by more than 4%. That is Bloomberg Intelligence Analyst Charles Shum. Coming up, we'll get you set up for your trading day with more earnings and more Fed speak. That's next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in for Danny Berger in New York. Now a look at what's ahead today. We'll get US retail sales and jobless claims data. That's at 8:30 a.m. Eastern Time. Then Fed speak coming from Kugler, Daly, Cook and Waller throughout the day. A big day for Fed speak. Big day for earnings too. They continue with Netflix reporting after the close. So let's have a look at the movements of some of those that did report already. United Airlines lower in pre-market trading after the carrier cut its adjusted earnings per share forecast for the year. Archer Daniels Midland sinking after Trump said Coca-Cola pledged to use cane sugar in Coke beverages sold in the US. And Sarepta soaring after cutting more than 1/3 of its workforce and adding a black box warning to its gene therapy. Now let's have a look at how we're shaping up for the trading session. As you can see, we are still fractionally higher for S&P futures. The dollar index up higher as well. That's primarily thanks to the euro and the British pound. The sterling is weaker today after some data out of there. The US 10-year yield is still at 446.53, backed off just a tiny bit, but we will certainly be watching yields today for any more Powell fallout. That's it for Bloomberg Brief. Surveillance is ahead. This is Bloomberg.